move to Chapter 12, IAS 10, Events After the Reporting Period. Just a quick reminder, as if you needed one, with every standard, definitions, conditions, basic accounting treatment, and disclosure. That's what we've got to memorize. It's not too much. So let's take a look at this IAS 10 and see what's in here. Before we do that, let's be very, very clear on reporting period, or indeed reporting date. We know that that effectively is the year end. So let's say 31st of December 2024. We've got to be fixed on dates here. They're important within this standard. In terms of the first section, let's look at events after the reporting period. An introduction, definitions, okay? First things first, these are events that occur between the end of the reporting period, the reporting date, and the date on which the financial statements are authorized for issue. Now, we've just discussed the reporting date or the end of the reporting period. Dates on which financial statements are authorized for issue, that's the date on which they're going to be released. They're signed off. That's it. They're official. So that time window, as you'll see within the diagram in this chapter, is very precise. We know exactly the start and indeed the end. And that's crucial when we're dealing with slightly more complex questions, because the examiner is quite cute with this standard. He's going to mess around. With dates. So we've got to have a fix on them. We've got one window into which to compare or indeed consider whether or not events are adjusting or indeed non-adjusting. So let's look at adjusting versus non-adjusting. We'll take adjusting first. So what we're saying with this adjusting event is there are further evidence of conditions that existed at the reporting date. So really, this event is linked to something that was in existence in some way, shape, or form. They're all different by the reporting date, or let's say by the balance sheet date. Now let's take some examples, and we'll slow down here. There's several. I've taken these directly, as you see, from the study hub. First one, so the discovery after the year end of a fall in value of a property that took place before the year end. So I read that as it's definitely an event. It's definitely something that is significant or appears to be material. The fall in value of a property. We're not talking about a few pounds, I would suggest. But that it took place before the year end. In other words, this situation is linked to a condition that existed as at the balance sheet date. That must be adjusting in some way. Second one, the amount receivable from a customer has become bankrupt after the year end. Well, I think if there's an amount receivable in our financial statements, clearly that's a balance due as at the reporting date, as at the year end. Now, that company, that individual has become bankrupt. That's certainly an event. Seems like it's material, and indeed that condition existed because that balance was included within our accounts receivable listing. So absolutely, that's got to be adjusting. Next one, sale of inventory for less than its cost after the year end. In essence, what we're saying is that we have some valuation of stock or inventory as at the balance sheet date, but this inventory was sold for less. So yeah, conditions in play, some sort of material loss. Let's adjust for that. Adjusting. After date sales may give evidence of NRV. That's sort of linked into the inventory. Last one, discovery of fraud or errors showing the financial statements to be incorrect. Absolutely. So we've prepared financial statements up to and including the reporting date. Someone has been up to something during the year which means that the financial statements as they stand in whatever way, shape or form are incorrect. That's certainly a condition that links to, in effect, a set of transactions prior to the reporting date. So hopefully you get the gist of it. Now remember, as I've said elsewhere, the key, or indeed the proof, is in the pudding. We can look at the theory, but let's look at the questions. That's how you're going to hone in on this and get quicker at getting these answers right. What about the flip side? Now, what about non-adjusting events? So, to define, indicative conditions that arose after the reporting date. So we're very, very clear. We're comparing, existing at the reporting date with arising after the reporting date. So let's clarify in terms of some examples. First one, the acquisition or disposal of non-current assets after the year end. Now, we look at that and we think, well, okay, we had non-current assets as at the reporting date. We simply disposed of them, or perhaps we acquired some. That doesn't seem to be anything iffy, or there doesn't seem to be anything untoward there. That's simply the sale or disposal, maybe at a loss, maybe at a profit, of a non-current asset, piece of equipment, a motor vehicle, a building. Non-adjusting. Fire, flood, or other catastrophes that destroy assets after the year end. Now, let's think about that. Did we know that there was a possibility of fire? Well, maybe we're insured. But strictly speaking, there was no condition or issue that existed prior to the reporting date, prior to the balance sheet date, that links in with the fire a couple of months after it. We can't go back to the accounts now and write them down and say, well, we should have known. Absolutely not. That's a non-adjusting event. The third one, the announcement of plans to close down part of the business. Now note, we're talking about closing down part of the business. Now that seems fairly significant and probably very, very material to the company, the management and employees. But at the end of the day, this announcement occurred after the reporting date. And indeed, that condition, if you will, really didn't exist prior. The announcement is after. So, non-adjusting. Last one, lawsuits against the business, or started by the business, that begin after the year end. Not before, after. So again, we're not talking about some sort of issue or issues that arose by the reporting date. These are after the reporting date, i.e. after the year end. Okay, so in summary, two sides to the coin. Let's be familiar with those words, existing and indeed after. Let's be familiar with what we mean by reporting date. Let's be familiar with the phrase authorized for issues. I've seen several questions in the FAOT exam that examine just that point. What does authorized for issue mean in terms of where it sits in that sort of window of dates? Let's move on from there, given the fact that we have a feel for examples, and talk now about accounting. Remember, as I've said, with all standards, definitions, conditions, and basic accounting treatment. Let's look at adjusting events first. Now, they sort of do what they say in the tin, don't they? Really, adjusting. So, first things first, should be retrospectively adjusted in the financial statements. We need to go back to the financial statements as they stand. They're prepared, yeah, and let's adjust them for that event. Let's change. Let's put a journal in. Let's reduce that stock. Let's account for that fire or theft or fraud in some way, shape, or form. In essence, what we're saying is that these adjusting events manifestly affect the financial statements in a numerical sense. Outside of that, how would we do it? Well, we're talking, I guess, broadly speaking, about assets or liabilities in some way, shape, or form. We should recognize, or indeed amend, using journal entries. You remember from our studies, the journal. Doesn't that allow us to adjust a set of accounts once we've produced the trial balance, we've produced the statement of financial position, we produced the profit and loss account? Well, hold on a minute. Before we send these through for authorization for issue, let's put in this journal entry to adjust these accounts for this adjusting events. That is what the standard says. We have to do it. End of story. There's no, well, I don't really want to. You have to. That's what the standard says. We need to adjust the accounts. Now, flip side, non-adjusting events. No adjustments. Repeat, no adjustments are made to the financial statements. I'm not going back and adjusting the financial statements because they're non-adjusting. I've decided on that based on the definition and based on what the standard tells me. But note, let's be careful here. If this non-adjusting event is material, we disclose it in the notes. So two things there. Material. Now, I've touched on that before. For material, read significant, read large. Now, the examiner in a question has to tell you whether or not an area, an event, a transaction is material. He's not asking you to decide if it's material, so don't worry about that. They will use, more than likely, the word material or something like significant or extremely large, and possibly make you sort of guess a little bit. But the bottom line is, I'm not overly worried about whether or not you'll see that this item is extremely significant for the business. I think you'll spot that. What I'd be more concerned is do we know what we mean by disclosed in notes? And indeed, do we know how to disclose information? We'll see that towards the end of this particular mind map. But in essence, at this stage, let's just say that disclosure in notes simply means, in relation to this non-adjusting event, give the details. Give the details of this non-adjusting event. Do not put a journal in. Yeah. Give the details. What's the dates? What's the amounts? When did it occur? How did it occur? Broadly speaking, we're talking about information. Disclosure means, in the notes, it simply means providing the user, providing stakeholders with more information in relation to a particular area or particular item. Okay? Let's move on from there to talk about that very thing, disclosure. Now, there's a couple of things here that I think are important. I've said when we're talking about standards that disclosure area is sort of the fourth area. And with each of the areas, definitions, conditions, basic accounting treatment and disclosure, I've said, let's memorize. Now, I'm going to contradict myself here in one way. What I'm going to say is this. When we talk about disclosure, what we mean, as I've just mentioned, is more information. So here's a typical example. We're talking about, let's say, a non-adjusting event. Yeah. What does the standard say we should disclose? The nature of the event, estimate of financial impact, a statement that a reliable estimate of financial impact is not possible if an estimate isn't possible. So broadly speaking, and again, I'm generalizing here a little bit, when we think about disclosure under the banner of any standard, yes, I said any standard, I think it's not really a question of, can I memorize everything per the standard that they say has to be disclosed? Because really, in essence, when they require disclosure, you sort of disclose everything. So my point is, if you're ever stuck in a question, whether or not it's in FA or elsewhere, let's say in strategic business reporting or financial reporting, or any area that requires you to relate to an accounting standard in the area of disclosure, your answer should be disclose everything. You're really disclosing everything. What are you not disclosing when we think about a non-adjusting event? Well, certainly I want to disclose what it is, i.e. its nature. If I know a financial impact, I'm going to disclose that. If I don't know a financial impact, I'm going to say I can't because a reliable estimate is not available. I hope you get what I mean here. I'm trying to look for ways to score marks if maybe I can't remember all the disclosures, there's too much information. Well, what I'll do is I'll just write down that I'll disclose its nature, its amount, the date, the this, the that, and on and on and on. Do you see? I hope that makes sense. So really, in terms of where we are right now, we've discussed the sort of two options under this standard. The left-hand side here, outside of the disclosure area, just a few little sort of add-ons. One of them being the area of dividends, and this is an area that under this sort of banner of events after the reporting period sometimes causes students difficulty. Let's be clear on the two sort of main options, as it were. So in the first instance, where we have dividends declared to shareholders but not paid at the reporting date, they're a liability. In other words, within the accounts, we need to account for them, i.e. journal them in and create a liability. So what I mean by declared, we're saying that in effect it has been decided that a dividend will be paid, and that was decided by the reporting date. So there's a liability. There's no way around it. We don't decide a day later, do you know what? Let's not pay those shareholders that dividend. It has been declared. Those dividends have been declared. Therefore, that is a liability. Okay? Now, let's contrast that to dividends proposed or declared after the reporting date, but before the financial statements were authorized, are just disclosed in the notes. So you'll remember from the other side of the mind map, we have that time window, don't we? From the reporting date through to the authorization date. So it seems to me what we've got here in the second branch is dividends proposed or declared in that window. Now, they are not recognized as a liability because they're not. They're just disclosed. In other words, the details are disclosed. And indeed, in terms of disclosure information, what do we think we would disclose? Well, I think we'd disclose the amount. I think we'd disclose the possible date or relevant year, in effect, and any further details that we thought were relevant. But that's basically it on a dividend. So you'll see with these two branches that dividends tie in nicely to this area and sort of give us an example, really, don't they, of events that are not quite adjusting because these would have been journaled in as soon as they were declared, first branch. And the second one would simply be disclosed as in non-adjusting event, certainly not a journal, certainly not a liability. Okay, so that's just an add-on really in terms of our information and our knowledge here. Now, one thing that we do need to do, and you'll see this diagram within the chapter, is just show the interrelationship between IAS 10 and IAS 37. Now, if you're not 100% au fait as yet, we're simply talking about provisions, contingent assets, contingent liabilities. So there is certainly a link. Let me run through the diagram first and then sort of tie it back to the link in a slightly different way. So we know that with IAS 37, really what we're talking about is the idea that we may have to provide for something in terms of it being, let's say, a debt or a liability, or the item may be a sort of contingent liability, it may be conditional on something happening, or could be a contingent asset. Okay, so there's the sort of broad definitions. Now, obviously, in terms of date, information that is provided to us in terms of the relevant date may come at any point. Okay, so let's look at the top of the diagram. It says, did the condition exist at the reporting date? So let's just say we're talking about a contingent liability, a sort of a dependent liability. Well, if this happens, then you'll have to pay this. If it doesn't, then you won't have to pay it. So let's just say, going to the left, there's a condition that existed at the reporting date. Yes. Okay. Well, if it did exist at the reporting date, then as far as we're concerned, that is an adjusting event. Okay? Next question. Is the final outcome known when the financial statements are approved, in other words, authorized for issue? Let's go down the yes branch. Yes, it is known. So adjust for the event, i.e., recognize the provision, journal that provision into the accounts, change the accounts. Let's go down the other side. No, the final outcome is not known. Well, disclose the contingent liability or indeed the contingent asset in accordance with IAS 37. We know what disclose means. Let's go back up to the top. So we're dealing with the top question. We've gone down the left-hand side, or the yes route, i.e. adjusting. Let's go down the right-hand side. Did the condition exist at the reporting date? No, it did not. Okay. Therefore, it is a non-adjusting event. Let's consider this next question. This is important. Is the going concern basis appropriate? In other words, do we accept that the company will continue to operate in the normal way for the foreseeable future? Well, let's say yes, we do. Okay. On that basis, let's disclose if material in line with IAS 10. Let's go back up. Is the going concern basis appropriate? Let's say it's not. This company is going to hit the deck next week. Okay? Then prepare statements on breakup basis. Now, what does breakup basis mean? Well, it certainly doesn't mean going concern basis. It means if we had a forced sale of all assets, equipment, stock, debtors, you name it, immediately next week, in a few weeks, what would we get? Because you'd probably get a lot less than you would if you sold them in normal channels, in the normal way. If you're forced to sell something and you have to sell it as quickly as possible, it's highly likely that you're going to get less for it. So breakup basis, or statements being prepared, or accounts being prepared on a breakup basis, really means a sort of a basis on which you're looking at a forced sale, which is highly likely to result in lower figures being included in the accounts. Write down your accounts. Okay? So, in just coming back in a loop now, I guess what we're saying here is that the sort of underbelly of IAS 37, provisions, contingent assets, links nicely, doesn't it, with IAS 10? Because we are talking about a very, very similar sort of thing. Either the condition existed or it didn't exist. Either the event is adjusting or it isn't adjusting. Hopefully you see what I mean with that. Again, let's practice the questions. We will get better and better. Trust me on this. That's how I did it. That's how students who have passed this exam have done it with me. We don't need to be perfect. We don't need to be experts in these standards. Certainly not. Many students that I've taught have passed with just a reasonable level of knowledge and some good old hard work. Okay? So that concludes chapter 12, IAS 10 events after the reporting period. Wasn't too bad, I don't think. Maybe you thought it was, so my apologies if so. Let's keep practicing, stay positive, work hard, and get through this paper. Thanks for listening. I hope that all is going well. Cheers.